Hi everyone. Here we are with discussing method of accounting, section 145, okay, of the Income Tax Act 1961. So it basically provides for the method of accounting, okay. So it requires income chargeable on the head PGBP or IFOS to be computed in accordance with either the cash or the mercantile system of accounting. However, we have some section called as section 145B where there is certain income which will be taxable in a specific manner. So, for example, if it is an interest received by an assessee on compensation or enhanced compensation, okay, um, then it will be deemed to be the income of the year in which it is received, okay, and it will be taxable to the head IFOS. Similarly, the claim for escalation of a price in a contract or export incentive shall be deemed to be the income of the previous year in which reasonable certainty of the realization is achieved. And then we have a third one, assistance in the form of subsidy or grant or cash incentive or duty drawback or waiver or concession or reimbursement, whatever a name called, which is given by either central government or state government or authority or a body or an agency, either in cash or in kind, shall be deemed to be the income of the previous year in which it is received, provided it is not charged to the income in any of the earlier previous years. Okay. Now we have three types of income, right? One is compensation or enhanced compensation, which is deemed to be income of the year in which it is received. Second one is a claim for escalation of price in a contract or export incentive. Again, it is deemed to be the income of the previous year in which a reasonable certainty of realization is achieved. And third, any form of subsidy or grant which is given by central government, state government, or any of its bodies shall deem to the income of the previous year in which it is received. Now, we move on to section 145, subsection 2, which gives the central government a power to notify ICDS, which is nothing but Income Computation and Disclosure Standard. Okay, for now we have 10 ICDS. 10 ICDS. Let's repeat it together with me. Yep. ICDS 1, accounting policies. ICDS 2, valuation of inventories. ICDS 3, construction contracts. ICDS 4, revenue recognition. ICDS 5, tangible fixed asset. ICDS 6, the effect of changes in foreign exchange rate. ICDS 7, government grants. ICDS 8, securities. ICDS 9, borrowing cost. And ICDS 10, provisions, contingent liabilities, and contingent asset. Okay, why did I take this topic particularly today? Okay, because it's most ignore a topic, okay, but still we have some MCQs in it. Again, we have some theory questions coming up in it, okay, and there is a high probability that this could also be checked or tested in question number 1, okay, by they could ask you to compute what is the construction contract amount, something like that, okay, because it's covered in the PGBP, right? Okay, I hope I made myself clear. Now it is applicable. It is applicable. Okay. When it's all applicable, it is applicable only for the computation of income under PGBP or income from other sources and not for maintenance of books. Books you maintain whatever you want. Okay. But while disclosing or computing the income tax, you have to follow this standards. Okay. Whenever there is a conflict between the provisions of the Income Tax Act and the ICDS, which will prevail, the provisions will prevail. Okay, this is also clearly mentioned. Okay, and then the scope paragraphs will be given tax provisions. So all normal things. Okay, disclosure requirement, specific disclosure requirement for each standard is given. Okay, now ICDS 1, it is accounting policies. Accounting policies. Okay, we have been given importance of significant accounting policies, and basically the achievements would be going concern, consistency, and accrual, GCA, right? Going concern, consistency, and accrual. Okay, but does not primarily focus on materiality and prudence. Okay, that is not focused, but in accounting we also focus on that, but in income tax we just focus on going concern, consistency, and accrual. Okay, and then again substance over form to be there, and market to market, that is loss or expected loss, that is fair value method of accounting, that is not followed under Income Tax Act, that is not followed under income tax. Okay, or ICDS. Okay, then ICDS 2, valuation of inventories. Valuation of inventories. What does inventory mean? Stock in trade, raw material, work in progress, right? Let's read it, okay? Which is used, held for sale in the ordinary course of business. That's nothing but stock in trade. In the process of production for such sale, WIP, raw material, WIP, finished goods, okay? In the form of materials or supplies to be consumed in the production process or the rendering of services, nothing but the consumables and the raw materials, okay? Clear? Now, this again, it is in line with accounting standards, which says that it has to be valued in the lower of cost or NRV, or lower of cost or NRV. Okay, and again, gives a disclosure requirement. What is the disclosure requirement? I have to state the accounting policy which I have adopted for, okay, and the cost formula which I have used, okay, and total carrying amount and the classification appropriate to a person. Now, moving on to the ICDS number 3, there is nothing but construction contracts. It is to be applied only when you have an income from construction contract. Only, generally it will not be applicable. Generally, right, when a real estate or some other construction contract having assessees would be applying this particular ICDS. Okay, which method is this? It suggests the percentage of completion method. Percentage of completion. So we'll try to find out what is the percentage of completion and then apply the same percentage to total revenue and total cost. Okay, and that will be recognized as contract revenue and contract cost. Okay, and this is not applicable for now because it's very old now. Okay, now it also has some disclosure requirement, like I have to disclose the amount of revenue recognized as revenue in the period, the methods used to determine the stage of completion of contracts in process. Either I'm used input method or output method. Okay, then ICDS number 4. H is the most important that is used by all TCCs, right? Revenue recognition, revenue recognition. This deals with the base of recognition of revenue arising in the course of ordinary activities of a person from sale of goods, rendering of services, the use by others of a person's resources yielding interest, royalties, and dividend. Sale of goods, rendering of services, interest, royalty, and dividend. Okay. If something like a construction contract is dealt by ICDS 3, right? Then this ICDS is applicable. Okay. What is new? It is a gross inflow of cash, receivables, and other consideration. Okay. And in an agency relationship, it is the amount of commission. It is the amount of commission. Generally, it is a gross amount, gross inflow. But in the case of agency relationship, it is the amount of commission. Okay. And I have to recognize only when there is a reasonable certainty. These are all in line with accounting standards. Okay. Again, for service transaction, we are required to use percentage of completion method. Okay. If I'm going to do number of acts, okay, I'm not able to exactly count it. Then I can use a straight line method over the time period horizon. Okay. Okay. And I have a contract, but it's less than 90 days. Still, I have to apply the POCA method. Exemption given to you, which says that rendering of services under that contract is completed or substantially completed. At that time, you can recognize the revenue. Okay, what are 3 things? If revenue transaction is there, then I have to use POCM method. Okay, but I am doing indeterminate number of acts. Okay, then I will use a straight line method and recognize it over a specific period of time. Okay, if the service contract is less than 90 days, then I will recognize the revenue once the service contract has been completed. Okay. What are the disclosure requirements? I have a disclosure requirement which is the amount of revenue from service transaction recognized as revenue within the previous year, method for computing the state of completion, and then information relating to service transaction in progress at the end of the previous year. Moving on to ICDS 5, tangible fixed asset. It deals with the treatment of tangible fixed asset. What does it mean? Now we have been replaced with the word called property, plant, and equipment, but still in ICDS it is tangible fixed asset, which means land, building, machinery, plant and furniture held with the intention of being used. Anything held with the intention of being used and is not held for sale. Okay. Then again, the cost will be the cost of acquisition, and if I have acquired exchange of other asset, okay, then the fair value that will be taken as actual cost. Okay, depreciation will be based on which method? A block of assets concept, right? Then other rates will be based on ICD income tax act, right? Then I have to disclose the opening balance, additions during the year greater than less than 180 days, right? Then reductions during the year with dates, depreciation allowable, and value at the end of the year. Generally, here we have only one method. Generally, we have only one method known as letter noun value method. Now, ICDS, the effects of changes in foreign exchange rates. It deals with the treatment of transactions in foreign currency, translating the financial statement of foreign operations, and treatment of foreign currency transactions, the nature of forward exchange contract, all the foreign exchange transactions, okay? If I am getting an exchange difference, which is on settlement of monetary item, okay, or conversion, okay, then it has to be recognized as income or expense in the previous year, okay? I mean, if I'm having a monetary item, either settlement or conversion, I have to recognize in that particular year. If it is non-monetary item, okay, I will not be recognizing anything. I will not be recognizing anything, okay? Which means I'm not recognize any foreign exchange differences. Monetary items, I have to convert using the reporting currency. There is a rate. Which rate? Closing rate. Which rate? Closing rate. For monetary items, it is closing rate, and non-monetary item, it is converted using the exchange rate at the rate of transaction. At the rate of transaction. If it is inventory, non-monetary item, I have inventory, but I am carrying it at net realizable value. I have inventory, okay, which is a non-monetary item. I am going to carry it at net realizable value, okay. It shall be reported using the exchange rate that existed when such value was determined, okay. Generally, what happens for non-monetary transaction, it is at exchange rate at the date of transaction. So I'm not recording the cost. I'm going to record it at the NRV. I am going to use the exchange rate that was prevailing when the NRV was determined. When the NRV was determined. Okay, all these things have to be disclosed. Okay, now ICDS 7, government grants. So it can be called as subsidies, cash incentive, duty drawbacks, etc. Okay, but it does not deal with government assistance other than in the form of government grants and government participation in the ownership of enterprise. And we can recognize the government grants only when there is a reasonable assurance that I will be able to, the assessee will be able to comply with the conditions given. Okay. Government grants shall not be postponed beyond the date of actual recognition. I'm going to recognize it. Okay. I can recognize only when I have a reasonable assurance that I will be complying with the conditions, and then I will receive the grant. But it cannot be postponed to a later date beyond the date of actual receipt. Okay. It recognizes, this ICDS requires government grants which are related to depreciable fixed asset. Okay, we had in accounts we have two types. Either we could deduct it from the cost or keep it as deferred income, right? But in ICDS, we have to reduce it from the actual cost or WDV. Actual cost and WDV. If it is not directly relatable to asset, then reduction of the amount of the grant should be made in same proportion as such asset peers to all assets with the reference to government grants is so received. I'm not able to specifically say for to which asset, which, okay, say I have a received grant for a factory, okay. Under factory I have lots and lots of assets, okay. So, to which asset should I, from which asset should I reduce this amount of government grant? The ICDS states that please do in a proportionate method. Please do in a proportionate method. Simple, as simple as that. Okay. Now, again, you're going for a non-depreciable fixed asset. Okay, for that I have to recognize it in over income as over a period over which the cost of meeting such obligations is charged to income. I have a non-depreciable fixed asset related grant, but it is conditional. Then, whenever the conditions are satisfied, related costs are charged to profit and loss account or the income statement. At that time, I will also recognize the revenue. Similar to deferred income concept. Okay. Standard also requires the government grants receivable as compensation for expense or losses incurred in any of the previous financial year or for the purpose of giving immediate financial support to be recognized as income of the period in which it is receivable. Simple, right? I have already incurred the cost. Okay, now I'm going to receive it. Or I'm going to get it as an immediate assistance. Then recognize as an income for the current financial year or the current previous year in which it is receivable. Any other government grants have to be recognized as income over the periods necessary to match them with related costs which they are intended to compensate. The standard conditions and disclosure required nature and extent of government grants recognized during the previous year as income, nature and extent of government grants not recognized during the previous year as income and reasons thereof. Okay. Now, moving on to the ICDS 8. Securities. Okay. What does this mean? All types of securities. It deals with all types of securities. We have two parts here. Part A, it deals with stock and trade securities, and Part B deals with securities held by scheduled bank or public financial institution under any of the act. Bank or public financial institution, only those people are holding some securities, then that will be covered under Part B. Rest all securities held for stock and trade will be covered under Part A. Okay. For Part A, I have to recognize at actual cost on acquisition, which includes the brokerages charges. Okay. Then, if I'm going to get it as an exchange, then it will be the fair value of the security so acquired. At the end of the previous year, securities which are held as stock and trade have to be valued at the actual cost or the net realizable value similar to inventory. It is also the same. Okay. Cost or NRV, whichever is lower. Okay. And then I have to do it category wise and not for individual security. Category wise and not for individual security. If I'm not able to ascertain the actual cost, then FIFO or weighted average method will be used. Okay. For Part B, which is basically the securities held by bank or financial institutions, right? So I have to go in accordance with RBI guidelines. As simple as that. I have to go in accordance with RBI guidelines. Now, last but one, right? ICDS 9, borrowing cost. What does this mean? Generally the cost of debt, right? Here also say it does not deal with actual or imputed cost of owner's equity and preference share capital. Please don't confuse it with IFRS, okay? Or the Indies. Here it is basically both equity share capital and the preference share capital, both costs will not be covered under borrowing cost. It requires borrowing costs which are directly attributable to acquisition, construction, or production of a qualifying asset to be capitalized as part of the cost of that particular asset. Any other borrowing cost will be recognized as a expense. Okay. If it satisfies those conditions in the income statement. Okay, what does qualifying asset mean? When you go think about in this, what does it mean? Which takes substantial period of time, right? Here, qualifying asset has been defined to mean. So it is a means definition. It's not an inclusive definition. It is a means definition. Okay, but it's exclusive. This is the only thing which will be included as a part of qualifying asset. Land, building, plant and machinery, furniture are being tangible assets. All the intangible assets. Then inventories that require a period of 12 months or more to bring them to the saleable conditions. For example, the wine breweries. Okay, that could be an example of the inventories that require a period of 12 months or more. Only these will be included as a part of qualifying asset. Okay. It requires the calculation of both specific borrowing cost and general borrowing cost. Generalism, right? Specific, you put all the things specific to that asset. For the purpose of computing the amount of borrowing cost to be capitalized in a case where the funds are not borrowed specifically, then a qualifying asset would be such as it necessarily require a period of 12 months or more for its acquisition, construction, or production. Okay. And we have to disclose the accounting policy which we have used during that particular year. Now, the last ICDS, okay? Provisions, contingent liabilities, and contingent asset. Clear. Provision, contingent liability, contingent asset. We have learned it in accounting, and what is new here? It says that you are not required to follow this ICDS. This ICDS does not deal with financial instruments, those provisions, contingent liability, and contingent asset resulting from financial instruments, executory contracts, insurance business, and covered by any other ICDS. Okay. It also does not deal with the recognition of revenue dealt by ICDS on revenue recognition. Clear? You are not supposed to take anything from financial instruments, executory contract, insurance business, and which are already covered by any other ICDS. It specifies the conditions for recognition of provision, namely the existence of present obligation. That provision is present obligation as a result of past statement, where I have a reasonable certainty that outflow is there, which will result in outflow of economic resources embodying the economic benefits till the obligation. And I am going to make a reliable estimate of the same. It provides that a person shall not recognize a contingent liability or a contingent asset. However, it requires contingent asset to be assessed continually. When it becomes reasonably certain that the inflow of the economic benefit will arise, the asset and the latent income have to be recognized. You will think, why there is a need for checking the contingent asset again and again, because there is a latent income which has not been disclosed, right? So when it becomes reasonably certain that the inflow of the economic resources will arise, the asset and the latent income have to be recognized in the previous year in which a change occurs. It contains provision for measurement and review of the provision and related income. It also provides the provision shall be used only for expenditure for which the provision was originally recognized. It also have a specific disclosure requirement in respect of each class of provision, asset and related income recognized. That's it for the day. We'll catch up again for discussing the questions or the clarifications that have been given, which could be tested as a 1 or 2 marks MCQ. Right. Thank you. Until then, bye.